Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, and see what's going on. If you want to follow me at Finance Square Finance, if you want to join our community, finding-value.com, where I dive deeper into all these sectors, looking for potential investment opportunities. And I am looking for the most leveraged companies in the market that have the best risk reward and the highest probability of success. You can use the Mayday coupon code, it's one word, Mayday, for a discount if you're interested. The dude, he says the COMEX had 12 silver deliveries yesterday. The LBMA had 3,575. The naked short position currently is 580 million ounces. This year, HSBC has been the big short delivering silver. What false flag event are they going to use to claim force majeure? And that's the deliveries there in the LBMA from the dude. Daniel says self-inflicted. So German industrial production is currently more than 15% lower than at the end of 2017. The decline is broad-based. I'm wondering if they're doing this on purpose. Because, it says energy shock, destocking, weak demand. I mean, maybe they think that we've got an energy shock coming and we are slowly transitioning from where we were to where they think we should be in the future. If the energy shock does, we'll say, materialize over the next 5 to 10 years. I'm not talking short term, I'm talking longer term. Dividend Growth Investor says dividend growers and initiators have done better than non-dividend payers and companies with no change to dividends. So here's dividend growers and initiators in the gold, non-dividend payers, and no change to dividends. One thing I want to say is the data runs back to when interest rates peaked. So as interest rates have declined the entire time, it is obvious that the dividend growers would probably outperform as people have migrated toward dividend stocks since 1980. If we have an increasing interest rate environment, I'm curious to see how this all pans out and how well these do. We could see a downward move or a sideways move for a period of time, much like all of the 1960s, 70s. Here's my response to a response that's underneath. This is the Canadian dollar versus US dollar. We're very similar to the time of 2002, where we get these big breakouts and the Canadian dollar outperforms. Well, why is that the case? It's when the dollar goes down, usually from a slowdown that occurs in the tip here, a slowdown that occurs in the tip here. They lower interest rates, and then the Canadian dollar outperforms the US dollar. You generally see commodities go up when the dollar falls, which is rocket fuel for commodity-based currencies. So I think that's going to occur again. It's the same setup as that we had right here. Same setup. Why is gold breaking out? This might give an answer. What's going on in Shanghai, China? So we're way up there. For Chinese gold trading activity explodes. Look at that breakout here, guys. You draw a little trend line going through here. And a big break. Trading volume ripping it. We got rock bottom entry. Says now look at this 10-year bottom pattern in the TSX Venture. Gold miners will be the trade of our lifetime. The left shoulder, right or head, and then a right shoulder. It's an inverted head and shoulders. We're at the bottom of the right hand shoulder for the TSX Venture. That also correlates with the Canadian dollar breaking out. Last time the Canadian dollar broke out in 2002-3, that's when the Canadian Venture ripped. Dow Jones Industrial Average versus gold. What we've got here is we've got a move higher from the early 80s. That was the bottom. That was the increase of interest rates, which pushed Dow Jones lower. Interest rates bottomed, and then the Dow Jones started to go up. We created a squeezing here into a corner of a pattern and broke to the upside. So that was all a declining interest rate environment and a big move from a low point of the Dow Jones upward. Now we're coming and peaked in 1999 and we're coming back down lower in this Dow Jones Industrial to gold ratio. Gold's been outperforming since 1999, 2000. We've had a pause from 2011 all the way up. We've squeezed. Now we entered this pattern from the top side down, and more than likely we are going to break to the downside to compress the ratio probably down to 1, potentially 1. And that's way down there. We could even go lower than that. And to zoom in on this area over here, there's our big selling pressure move. Coming on up, big selling pressure move and a breakout and a potential break lower where gold outperforms the Dow Jones. We're just starting that big move for gold. Here's another one, Dow Jones Industrial Average versus oil. Oil does follow gold, but it's generally delayed a little bit behind it. Is it time for oil to outperform in the immediate term? I don't know. Longer term, I think it's going to rip. But medium term, hard to say. Short to medium term. So this is what it looks like. We have two very similar fractals going on. We had a big run up where Dow Jones outperformed crude. Occurred in the 80s all the way till 1999. We just saw that with the Dow Jones to gold ratio. It is a match, and that's why I'm showing all of this. It all aligns and matches up. We had a big impulse move lower. We had a counter move all the way back to this line up here. Then we reversed lower and compressed crude oil against the Dow Jones all the way down to this bottom level in 2008. We then did a counter trend move all the way back up where Dow Jones outperformed. We had a 2020 bottom. That was your COVID crash where oil went negative. And then we had a strong impulse move all the way to 2022, 2023, 2022. And then we came back up. And I think that we are in that circle very similar to the year 2002. 2002 should ring a bell. Why does 2002 ring a bell? Because we were just looking at the Canadian dollar versus the US dollar. Ding, ding, ding. Those align. It's the dollar weakness that is going to cause this to fall. Now, is it going to be immediate? I don't know if we go a little bit higher. I don't know if we go sideways for a little bit. Because if there's a slowdown in the market, we could see crude oil underperform for a little bit. But I do think this will eventually work its way lower, probably to the downside here. If that occurs, we've got one heck of a move in oil. One heck of a move. And there we are with, what I did is I flipped it. I said crude oil divided by Dow Jones, because sometimes when looking at the charts like this one, we get a different picture when we flip the denominator and numerator. So what I see here is a falling wedge that we've broken out of, and we've got another falling wedge that we are probably going to get a false breakdown and a slingshot higher, where crude oil outperforms Dow Jones. Either direction. In the short term, Dow Jones falls faster than crude, or eventually crude oil goes up faster than Dow Jones, or you get a combination where crude oil goes up, Dow Jones goes down for a while, or sideways. Oil versus gold. So let's face the two off that we just did up there, and gold versus oil. When I look at it from a crude oil versus gold standpoint, I see consolidation periods. In the 1980s, we had a consolidation period of crude oil against gold sideways. Then we had a monster breakout in 1999 when commodities were cheap to equities, and we had a big outperformance of crude oil versus gold all the way up. Then we had in 2008 a large outperformance of gold. We had another big consolidation. And right now, we have had a capitulation bottom in 2020. We had a breakout of this ratio in 2022. And then we have been consolidating recently. And I think eventually this will break to the upside where crude oil outperforms gold. I think we will go into a shortage 10 years from now for crude oil. Like it will be short at the current price. Prices will go up and balance the market. Coming to gold versus crude oil. So I flipped it. We had a big outperformance of crude oil all the way to the breakout of 2014-15. We had a breakout where we had a kind of a spike higher in gold. We've come back down. We're starting to come back up. We're at a ratio of 1 ounce gold to 38 barrels of oil, which is incredibly cheap for oil. We could go up further and create another peak like we did in 2016. We put a line across and we've got a shoulder, a head, and a shoulder. And I think we're going to compress all the way back down. That would be my guess out in the future. A clear breakout for gold versus the consumer price index. There it is, a clear breakout. That's continuing to run. That is great for the mining companies. Great for the mining companies. That's their margins increasing. Just fantastic. And also, silver went up very well during these time frames too. So we could see a big run in silver as well. Tavi said, generally speaking, there are two types of investors who will interpret the chart below. Some will look at it and see a disaster, while others will immediately spot the potential for a major opportunity. I'm in the latter camp. So this is gold miners versus gold ratio, and we're starting to break that downtrend right now, where gold miners could outperform gold. And we just went over, gold is about to break out versus the US CPI, which is Consumer Price Index. This is the margins of this. So this should go way up as long as this keeps going higher. Housing starts, or stats, I should say. 7 million homes needed to alleviate shortages. We have a deficit of 7 million homes, according to this guy. 850,000 single-family units per year at the current pace. Median home prices are $422,000 today versus $266,000 in 2020. Half of the homeowners with loans have rates less than 4%, likely not selling. So we have a big gap in how many homes we need. Arbel Financial, should you take financial advice from someone less wealthy than you? Yes, I would. It doesn't matter the credentials of the person. What matters is the validity of what they are saying. So if someone was young and they said, you know what, I know of a really good investment opportunity, and I'll say, okay, I'll listen to you, and then I'll go research it. Just because my lead was from a younger person who may not be as wealthy, that's okay. I'll go check it out, and if it's good, I'll put money in it. I don't care where it comes from. It's only based off the validity of the argument or the data or whatever it is. Your job as an investor is to have more patience than the guy beside you. Data shows that the longer you stay invested, the lower your chances of losing money. The guy trading in and out of stocks every week is probably losing money but hasn't told you about it. That's what's going down. Completely true. Buffett's incredible performance visualized. So here's Buffett. He's down at about, 13, 14%. And he's done it for 55 years. And what he's done is he's compounded it longer than most people. The best investors, Joel Greenblatt, above 30% for a period of 20 years, that is ridiculous. Same with Jim Rogers, above 30% for a period longer than 10 years. That's all you need. You don't need to be over here necessarily. You just need to be way up where you can ride it for a high period of time. My 4-year average return between 2019 and 2024 was 41%. Now, can I hold that for a longer period? I don't know. But that's what I got buying the bottom of 2020 and rotating into some of those investments at the bottom of 2020. I doubt that I'll have a great year this year. Uranium's down, and oil's been tracking sideways to slightly lower, depending on the companies you're looking at. I was up about 36% earlier in the year, but I have had a pretty sharp pullback recently in oil specifically. Obviously, I'm doing very well in the precious metals sectors, and I don't try to maximize my returns for this metric here. I try to balance the portfolio to some degree and try to ride it across 6, 7 different sectors. So I'm not taking all my money and putting it into 1 or 2 sectors, trying to completely outperform, because that does increase your risk of getting blown out at some point if you're doing that. So I try to take a little bit more balanced approach, use the asymmetry to my advantage, and if I have a year that's off, whether it's a down year or still an up year, it doesn't really matter for the long term. And I'm trying to maximize performance, risk reward, and being able to not go all in. Even though I know the market conditions and what's cheap, I can overweight those sectors. I don't want to go all in because that's where you have a problem if something goes wrong. Dividend Breeder says a year ago, my projected annual dividend income was $7,500. Today, it is $8,234. I currently reinvest 100% of this, but eventually could convert to supplemental income. Yeah, that's great. And this is a metric that you should be following. In commodity companies, your dividends move up and down based off of the commodity price. It is a very inflation protected portfolio. If you have inflation sensitive commodities and equities, where they, mining companies or whatever they are subjected to increased dividend payments to the shareholders based off the commodity price. And that's what I want exposure to. So this could be 7,500 a day, but a few years from now, that could grow rapidly from the commodity price going up. It doesn't mean that you put more money in to actually get the bigger dividends. And Finley says Clarkson's up to 28 redeliveries of Saudi jackups slowed activity in the first half of 2024. However, the jackup market looks to be weathering uncertainty well. Overall jackup utilization is projected to reach 91% by the end of 2025. And this is the jackup rate index, continuing to move higher off of this big bottom from 2016 to 2022. And we do have investments in this, benefiting from it. Markets are speaking. So these are the top performers. 2020 is gold, 21, 22 is commodities, 23 is S&P 500, 2024 is gold. And what does that mean? If you look at gold, a lot of these movements. So what you'll get is a good gold leader, and commodities generally these timeframes, unless it's the end of a period. So 2008 was the end of a period. Your crash. So U.S. Treasuries will do well, and then they printed money, but they couldn't re-inflate the commodity market again. So gold outperformed, but that money went into gold, not into other things. So when they lowered rates, look what occurred in 2009. They lowered rates. Emerging markets did well. And then obviously after that, emerging markets did poorly. It was the market. What's occurring here is the business cycle went into an expansion phase in 2000. Commodities, 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 they're all up at the top here. Then it faded in 2008. It was done, minus 42%. And that's when it all shifted. Commodities are horrible during a recovery phase of real estate. You can see them all down here. And now we've shifted back. We're back 2020 at bottom, in my opinion. Commodities outperformed these past couple of years that's where I've been. We're going to get a slowdown here where commodities are going to probably underperform, which they are. And then it's going to flip back up. Gold's going to be our leader, and commodities are going to outperform again soon, in my opinion. Nick Zaccardi says anybody suggesting a recession is imminent is ignoring reality. This is a graphic from Apollo. So, restaurant booking, air travel, daily debit card data, strong, strong, strong. And then weekly data, Atlanta Fed GDP 2.5%, GDP index Feds 2.3, retail sales are strong, jobless claims are sideways, hotel occupancy rate is strong, bank lending growing, bankruptcy filings are trending lower, credit and debit card is solid, slightly weak for global jet fuel demand. Broadway show attendance strong, box office is strong, S&P 500 forward profit margins are near record highs. Business formation is rebounding, and ASA temp worker staffing is sideways. So where's the weakness? This data isn't showing it yet. And that's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.